Thanks for joining us for the third quarter 2022 investment update from San Diego Foundation. If you don't already know me, I'm Matt Fettig. I serve as Chief Investment Officer for San Diego Foundation and oversee our $1.3 billion in assets. Obviously, it's been a troubling time for the capital markets. After many, many years of prosperity in our economy and around the globe, very strong returns for both stocks and bonds and other investment instruments. So far in calendar year 2022, markets are down considerably. To give you a sense of what that means, global stocks are down over 25% so far year to date through September 30th. And much more troubling, bonds are down over 15 or about 15% for that year-to-date period. Now, as you're building portfolios, most investors will build portfolios with a combination of stocks, which are typically used for growth and capital appreciation, and bonds, which are meant for income and defensive characteristics. So it is very unusual to have a period where stocks are down at the levels they are at, and to have bonds also produce such a strong negative rate of return. What that would tell you is some combination of bonds and stocks would be down anywhere from 15 to 25% so far this year, depending on the weighting to each of those categories. I'm happy to say that our results have been better, though negative, in many of those cases. And part of that has been our ability to use tools that fall outside of those bond and stock traditional instruments. And we'll get into that a bit more. But I do want to say this period with bonds down 15% and 3/4, it's really the worst period on record for bond returns. So it is very abnormal. So what's contributing to that, or detracting, maybe a better term? Well, certainly the inflation prints that we have had both here in the US and around the globe are quite troubling. And the Federal Reserve, with a dual mandate of full employment and low inflation, has achieved that full employment outcome for the last several years and is now very keyed in on reducing inflation to around the 2% level. There are other factors that have contributed to this decline as well. First of all, I should say the Federal Reserve has combated inflation by raising short-term interest rates. That is the main tool that they utilized. And so for the first time in many, many years, interest rates are not only over zero, but they are much higher in that 4% plus range today. We've also had some geopolitical concerns with the Russian invasion of Ukraine earlier in this year, and that really impacted commodity prices. So you have had a very dramatic spike in commodity prices like oil, natural gas, grains, other areas that have really exacerbated some of this pricing pressure that we had coming out of COVID with all of the supply chain issues that most of you are aware of. It's really been those events that have culminated in this environment that we're in today and these negative returns that the market has produced. Fortunately, over the last couple months, markets have stabilized a bit and ticked a bit higher. But certainly the billion-dollar or trillion-dollar question today is, will the US economy and other economies across the globe enter a recession? And just how big of a recession will that be? Or can the Fed and other central banks help to create more of a soft landing scenario where we're able to combat inflation, get it under control, bring it back to normal levels, but at the same time be able to maintain some element of economic growth in this country and beyond? So I think that summarizes, the environment of kind of where we are today. And with that, I'd like to transition into providing you with an update on the investment performance of San Diego Foundation's various investment portfolios. So we'll start with the endowment portfolio, the largest portfolio we manage at just about $730 million. And remember, these endowment assets are perpetual assets. They have the longest time horizon of any investment portfolio out there, perpetuity. And therefore, we can do things with this portfolio that a typical portfolio cannot do. And that is largely because we have the power of time on our side. So for the quarter, the endowment was down 3.5%, outpacing its policy index, which is an index of indexes that represents how the portfolio should track over time. And for the calendar year-to-date period, the portfolio is down 12%. So as I mentioned, bonds are down 15%. Global stocks are down 25%. So how do we have a better outcome than bonds and stocks? Well, we have a number of other assets in the portfolio that are non-traditional in nature and have the ability to help us diversify the assets to protect during periods like that. We have about a 15% exposure to hedge funds in this portfolio. The hedge funds that we invest in tend to protect capital during down periods for the market. So to give you a sense, our hedge fund portfolio is roughly flat for the first 9 months of this year, while the market is down significantly more. We also have illiquid assets like private real estate, private equity, that have also helped to protect capital during this downturn. So proud to say it's never fun to report negative results, but we have been able to significantly outperform traditional portfolios and also outperform our policy index. Now, over 3-year periods, 5-year periods, 7-year periods, 10-year periods, as you see illustrated, the portfolio is up ranging somewhere between 6 and 8%, really right where we want to be from an endowment portfolio perspective. So moving forward, let's move on to the long-term portfolio. The long-term portfolio is a non-endowment portfolio. And so it really does rely more on those traditional asset mixes of stocks and bonds. For the quarter, the portfolio was down 4.5%, and calendar year-to-date down 16.7%. So this will utilize both stocks and bonds. It tends to be more stock heavy, given that it is a longer term, riskier portfolio. But this portfolio does have about 20% of its assets in hedge funds. Again, those assets are really designed to protect the downside in market periods like this. And that's how we've been able to protect capital and be at the higher end of that -15% to -25% range. Over longer periods, the 3-year period, the 5-year period, this portfolio is up over 3%, and over 7 and 10 years, still up a decent amount. So let's move forward again to the medium-term portfolio. Also, a more traditional portfolio, but tends to have a bit higher exposure to bonds rather than stocks. You'd think in this type of environment, a portfolio heavy in bonds would be less risky than a longer term counterpart. And what's really interesting about this environment is that has not been the case. So for the quarter, the medium term portfolio was down 4.7%. For the calendar year to date period, down 16.3%. Flat over 3 years, and up a couple to 2 to 3% over the 5 to 10 year periods. This portfolio is designed to have lower volatility, but given what I explained in bond land, volatility has been higher in bond land. The good news here is while interest rates on the short end may continue to tick up as the Fed continues to raise interest rates, we're in an environment now where we are earning some fairly significant yield or coupon on our bonds. And we have not been in that environment for many, many years. That coupon or yield can help to offset any further capital depreciation we see by ways of short-term interest rate increases. So I think we're at a better place now than certainly we were at the beginning of the year. The intermediate term portfolio, one of our newer portfolios, consists 100% bonds. It has some short-term bonds and some intermediate term bonds. And what you see in this portfolio, down 2.9% for the third quarter and down 10.8% for the calendar year-to-date period. It really is astounding to see a 100% bond portfolio down as much as it is. But like I said, worst period in history, and certainly at a better place now from a yield perspective than we were at the beginning of the year. Finally, in terms of our non-endowment portfolios, let me talk about our short-term portfolio a bit. This is an interesting one, as this portfolio seeks to take no risk of loss. And to do so, it invests 100% in money market funds. Money market funds pay a yield, and that yield is highly correlated with short-term interest rates. So while that yield has been close to zero for almost a full decade now, interest rates are higher, and therefore there is some positive yield coming back to this portfolio. It's the first time we've really been paid for holding cash or cash-like securities in many, many years. And so it does provide an option, certainly a safe haven in an environment like this. Last, I want to go to the sustainable portfolios. Remember, the sustainable portfolios are invested according to environmental, social, and governance criteria. One of the very big differentiators in this portfolio is that it excludes energy and fossil fuel production. And we've had a scenario this year where in the first quarter of the year, really the market fell precipitously, and the only thing that worked were energy stocks. So by excluding those from this portfolio, it suffered a fairly large loss in the first quarter, and that's really been the case since. So down 6.5% for the third quarter and down 26.5% for the calendar year-to-date period. Same with the non-endowment version. They are invested largely the same at this point. So both the sustainable endowment and sustainable non-endowment portfolios are aligned at this point. Now, I've told you some fairly bad news in terms of what's going on in the economy and around the globe and how it's affected our investment portfolios. Let me just stop and say that what we do not do at the San Diego Foundation is react to these negative environments in the short term. We are longer term investors. We understand that losing your charitable dollars at a time when the economy is underwater is difficult. But the last thing we would encourage folks to do is to panic. Obviously, environments like this where the market occur, they've occurred throughout the course of history, and they've occurred with a lot more frequency than we've seen in the last 12 to 13 years. So we are largely not used to having an environment like this. But assets will reappreciate at some point. None of us can time the bottom. And I would just argue that a lot of asset prices have fallen to a level where things are on sale. And when things are on sale, markets get a lot more interesting, and the potential upside from here over the next 10 years grows quite a bit. So I will leave you with that. We appreciate you joining, and we will talk to you soon.